Good afternoon, and thank you all for joining us today for our preliminary results. What we're going to go through today is what we currently offer as services, the operational highlights for the year. Charlotte's going to then take you through the financials. I'll summarise what we've done this year and then take you through both the outlook and our strategy to develop this business over the next 3 to 4 years. So within this slide, you can see that our continued trend of Dialis, which is our expert witness brand, increasing as part of a revenue split has happened globally. It's moved slightly a couple of percentage points back on the half year, but that's simply with larger projects starting and finishing throughout the course of the year. Probably 3 or 4 years ago, it was 8 or 9%, and we've significantly increased that proportion of our business, which is our most profitable revenue. Our project services brand in the northeast of England is a standalone business, does very well for us, very well run, creditable business there, but only in the UK these days. That used to be a business that we repeated around the world, but have stepped back from in recent years. And Driver Group, which is the underlying brand that does the dispute resolution and claims and commercial work, makes up the balance of the business. So if we go to the next slide, it will tell us how that distribution is split around the world. We started in Americas about 3 years ago, and as you can see, that's predominantly a Dialis business. The balance being Driver Group. We don't do any project services work there. The Middle East, similar picture actually, although with more Driver Group work. The 8% indicated there as project services work would have been in Oman, which is a business that we've discontinued within the year. So next year that will disappear. Asia has a lot of contract-based work in it, and we need to increase the amount of expert work we do there. And that's beginning to happen and take root in that region as part of our overall marketing strategy, particularly in South Korea. And then the overall Europe picture you can see at the top, which is such a significant part of the business that it replicates, if in effect, the previous graph. But again, year-on-year growth towards our Dialis expert brand, which is what we've been aiming to try and do. And if we move to the next slide, there's a summary of our operational highlights for the last 12 months. We've managed to improve utilisation from 67.5 to 72.5. That's due in some part to having some significant commissions secured in the fourth quarter of this year. We have an ongoing cost reduction program that's been running for the last 2 years, and it will be completed by the end of this month. And those savings will feed through into the next quarter and the quarter after, as and when leases and the like come to their conclusion. Some of these things one has to invest in order to get the return, and it takes a little while. So we've delivered significant cost reductions across the business, but a big focus on getting the offices around the world to collaborate, which drives utilisation up, which is very helpful. And we've now got a new strategy in place to run the business over the next 4 years and get it to where we believe it can actually go. I'm pretty sure that the next slide will take us onto the financial summary, which is over to you, Charlotte.
Thank you, Mark. Very pleased to announce that we've made an underlying operating profit of £1 million. That's a 1.4 million turnaround from last year when we had a corresponding loss of 400,000. Profit from continuing operations is 100,000 compared to the loss of 2.4 last year, so another large turnaround of 2.5. Net cash has increased by 18% to 5.8 million, up from 4.9 million same time last year. That profit's delivered an earnings per share of 0.2 as opposed to a loss last time. Revenue from continuing operations has reduced to 42.6 for this year, mainly as a result of the restructure in the Middle East and APAC that we went through last year. Take you through a bit more detail on those figures. The revenue there reduced as explained. Cost of sales also gone down in relation to that, but gross profit's up to 10.8 from 9.3. Admin expenses are also down. That results in the underlying profit of £1 million. We have had some non-recurring costs this year, 0.26, mainly to do with the finalising a restructure in the Middle East. Share-based payments, 0.4, that's to do with spreading the cost of the LTIPs over the 3-year period, resulting in an operating profit of 0.4. We received some interest income this year as interest rates improved, and we had some of our funds on deposit, giving a PBT of 0.4, tax charge of 0.3, profit of 0.1. And then we did have a loss attributed to discontinued operations. That's the closure in Oman and Kuwait that Mark mentioned earlier, together with small costs for Hong Kong and Malaysia as we close those businesses after the restructuring. Next slide, please. Some KPIs there. Strong improvement in gross margin from 21 to 25%, utilisation up to 72.5, and EPS, the net cash there of 5.8, which is 11.1 pence per share, up from 9.4 last year. I'll now take you through each of the regions so you can see some of the detail. Europe and the Americas, this excludes the driver project services business because that's standalone. A revenue up to 27 million, segmental profit up to 4.5, headcount relatively flat, just down 1 at 114, and improved utilisation up to 68% for that region. Next slide is DPS. This slide looks negative and all of the arrows are going downwards, but actually we're comparing to an exceptional year for DPS in 2022. So it's still a very strong year. This business consistently delivers a 10% margin. And you can see there from the segmental profit, what delivered almost £1 million there from revenue of 8.5, 40 people and strong utilisation. That's because it's the contract work that has high utilisation. If we don't have the work, then we don't need the people anymore. So that's easier to manage for utilisation. Next, I'll take you across to the Middle East. Revenue down, part of the restructure. Segmental loss there. It's only just 0.1. It's 88,000, very close to break even, which from the 1.3 million loss last year is a massive turnaround in very short order from the restructure last year. Reduced headcount to 20, just the finalisation of that restructure, and massively improved utilisation up to almost 71 from where it was last year at 53. Asia Pacific is next. Revenue down again because of the restructure. A very similar, well, the same segmental loss as last year. There's a couple of reasons for that. We've had management change in Q4, and so some downtime there, but we had the related costs. And also some of the contract work there that we've had, and it's quite legacy, but ongoing, is at low rates. So the margin isn't very good on those, but they're coming to an end and we're moving away from that type of work. Account down just 1, and utilisation is actually down in this area, but that's because of the reasons I've just been through for the loss. So we're back in profit for that area from in Q1 of this year. Next, I'll take you through the profit bridge. So last year on the left, we're starting with, we had the loss of 2.4. Revenue has gone down a similar amount. Then we had an improvement on the cost of sales because it was lower, and similarly an improvement on the operating expenses. Net finance costs were income because of the interest. We had those non-recurring expenses, which is a small reduction there. Comparing to last year, we'd had the £1 million onerous lease charge, you might remember, so that wasn't there this year. Small movement on the share-based payments, resulting in almost a break-even PBT for the year. Next slide is the cash bridge. So again, on the left, we started at the 4.9 we had last year. Operating cash generated was £1 million. Lease payments were about 700,000. Increase in working capital generated £1.5 million. Contribution towards the increased cash balance. Small amount of tax there. The dividend almost £1 million at 0.8. And then some very small amounts for interest, capex, and small foreign exchange gain, resulted in our closing cash position of 5.8 at the end of September. Slide, please, Matt. Back to you, Mark.
Indeed. So having done a lot of work to turn around our position from a significant loss into decent profit for last year, that's the foundation for moving forward. And on that solid foundation that we've been building, we want to transform the business and take it forward. As a board, we've agreed that our vision, where we want to get to over the next few years, is to be the first choice provider of our expert witness and dispute resolution services globally. We've achieved that in some markets, but there's some work to do for it to be a global position. Part of that, and a big part of that, will be hiring the best people and being the employer of first choice for the best people in this marketplace. And that will lead us to secure work on the biggest and most complex disputes in the world. We already do an element of that, but we want to do more of it. And central, because our reputation is everything, will be, of course, continuing to deliver the best possible service to all of our clients. If we can achieve those, then what will flow from that is our ability to operate a profitable business that delivers a consistent best-in-class margin. So those are some significant targets that we've set ourselves, but we have, we believe, the foundations and the raw materials here to head in that direction and go off and look at delivering that. The next slide shows some of the steps that we're going to be taking along the way. We're going to rebrand our business over the next 12 months, area by area, but we're going to end up with Dialis as our overall brand that the business trades as. A project services business will remain as it is in the UK, that has a very loyal local following and doesn't do any expert work. So Dialis will be our brand moving forward, and we're going to focus on elevating that premium brand as far as we can in the marketplace. We currently promote 3 brands, so promoting 2 means that our spend, return on investment, can all be much more focused around making sure that we constantly push that brand to the elite status that it's already achieved to some extent. There's definitely more we can do. We moved away from having remote individual offices some time ago that were standalone cost centers. I've tried to link up the world using our hub and spoke model. We will be going further in that, and outside of UK and Europe, which will be our main hub for business, we'll be able to achieve some lower cost representation across the world, and the hub will be able to provide the people that does the work when there are peaks, and hopefully share some work also when there are troughs, which means that will help us deliver better utilization rates. We're going to promote some people and hire some people to reinvigorate our management team. Time has come to give some people in the business that we've been developing for a while the opportunity to step forward and help us deliver on our aspirations over the next few years. And those people are pretty much, with one exception, already in the business. So we'll be making those changes early in the new year. The next slide also gives some other key actions that we'll be taking. We've already started to overhaul how we are going to deliver our marketing and business development. We're going to be very focused on ROI. We are only going to have one brand to only invest in, that being the Dialis brand, in the future, so we can be very sharply in tune with getting maximum bang for our bucks in the BD and marketing area. Where we have offices overseas in all kinds of locations, we're going to be looking to encourage some local ownership and having partnerships outside of Europe and the UK that we can develop and grow in conjunction with our local partners. This is instead of growing larger offices overseas that are just wholly part of the business. And we want those people to have a stake with us in developing business across the world. We're going to invest in hiring some key work winners and some particularly well-known experts into the business. We very much want to attract those people in. That will help with our utilization as well when they require assistance to deliver their commissions. And part of that is the acquisition of talent, which is going to come in a number of different flavors. It might be hiring senior people and some of their assistants. It might also be hiring a group of people. In some cases, that will be treated as an acquisition where that group of people is effectively a very small business, 6, 10, whatever, or however many people it is. If we think that they're a great bolt-on, we'll be looking to do that. So those key actions overall will help deliver what we want to in the business over the next few years. The next slide shows the story as to how we know we're going to get there, because we have a vision when we've put these things in place across the bottom of the screen. And the reality of that is that some years will overperform and some years will underperform because of the volatile nature of the workload. What I would say is that over the last couple of years, we've got some new IT systems, we've got some new systems and reporting in marketing and BD as well that show opportunities. And we're refining our ability to forecast forward to the best extent that we can in that volatile market. So I think the peaks and troughs will hopefully become bumps and dips, and so we'll see less of them moving forward. And we will get there in the end, but it won't be a straight line. It's not a straight line type of business. And those of you that have followed the business for a while will fully understand that. On the next slide, we talk about the areas that we're looking to expand into. And in many of these areas, we've already done some work. We've worked on some IT disputes, but we need some expertise to come into the business and help us win more in that area. All of these areas of potential expansion are entirely closely linked to our core competencies regarding delay analysis, quantum, and some of our technical abilities. Engineering forensics for us is a way in which we'll be focused on getting our own tests and laboratory type services behind us to help develop the business in that direction. We currently sublet those things. We've done some aerospace work, but not nearly enough. And also that will take us into the defense market in some areas as well, which is important. We're quite big with things like offshore wind and conversion of vessels in the oil and gas market in terms of marine. Plenty of potential to hire more people and expand into that. And we've, for a number of years, wanted to have financial forensic accountancy as a service line because we know that that's quite close to what we do. And there's quite a lot of leverage between that and our core business. So there are a few areas there that we think we can grow into and bolt onto as services rather than just a purely geographic thing, which is where the focus and measurement has been in the past. So plenty of opportunities, we think, to acquire some talent in those areas and help to profitably grow the business. I think the next slide effectively summarizes what I've just said to you. We're planning to transform our business. We're planning to streamline with our preferred Dialis branding, focus completely on that expert market, along with the expertise that we currently provide in some of the services that Driver deliver. We certainly don't want to lose that work. We do want to grow some of that as well, but by being single branded, we believe that we can grow and invest our marketing spend, particularly in the right way. We're going to secure some new top-end experts, rainmakers that keep people busy. This is all about focus on improving utilization. We've done that a little bit so far, but there are definitely a good few percentage points that we can push that to. We like to develop talent in-house where possible, and we've got a strong succession layer, we believe, in the business that can start to step forward over the next couple of years. Our forecasting and marketing is going to be industry leading over the next couple of years in order to help us deliver that. A lot of work has gone into that already. And finally, we'll encourage some local partnerships and local ownerships in some of our overseas businesses outside of the UK and Europe. So a fairly significant number of steps there that we're going to take the business forward. And the board have done a lot of work in making sure that these are the right things to do, that we're confident these are the right things to do, and that we'll credibly be able to deliver them. So that takes us then into the summary and outlook. We've successfully concluded our restructuring process, wound down presences in Kuwait and Oman, one or two other smaller offices as well. And we've returned to profit in the UAE and Saudi Arabia. Cash position has improved significantly from last year. Cash collection generally across the world, thanks to Charlotte and the finance team, we've had a real focus on making sure, firstly, that we reduce these aged balances. We've collected a very significant amount of our older Middle East debt, and our new policies ensure that we only work with people that pay us moving forward. So all of those challenges are a thing of the past, and management can focus on other things, which is very welcome. Our cost-saving measures are in place. We'll start to feel the effects early in 2024. And our continued focus will always be on staff retention, hiring the best people, utilisation, cash collection, and pulling our overheads as tightly as possible. And if we do all that, we can believe we can take this business really somewhere quite significant over the next few years.
You mentioned as part of the strategy update that you expect to rebrand as Dialis. A two-parter. Has this caused issues within non-Dialis teams? And then with a greater focus on Dialis, what is your target as a percentage of revenues from the 37% you saw in 2023?
Well, I think there's a couple of questions in that. So to deal firstly with the point about effectively staff engagement, this we certainly can't be accused of rushing this, because we created the Dialis brand 11 years ago and have invested year on year in using it in all of our cost centers across the world and in promoting that brand to become well known and well respected, which it certainly is. So all of our staff are aware of that. Inevitably, in a business with 300 people, in some of which have been using a brand that they know well for over 20 years, there will be one or two people who have some concerns about that. Management will be addressing that with them individually and making sure people are comfortable in the way we move forward. But what we're not doing is inventing or creating some new brand or some new name out of thin air for everybody to get involved with. Almost half the business in terms of the expert team already have two business cards, one saying Driver Tret and one saying Dialis, because they work in both streams. So this is possibly one of the lowest risk rebrands ever, in a way, because it's actually a consolidation of existing branding more so than rebranding. So we see that as very limited risk. The second part of the question was, just remind me.
Just with the greater focus on Dialis, I suppose, what it is there a target as a percentage of revenues from the current level of 37%?
Yeah, well, I think that pure expert work, and we do expert work in its purest form with that 37%. That's where it's contentious work, and we're working in front of a tribunal, be it a court or an arbitration tribunal somewhere in the world. So that's quite specific at 37 to 40% of revenue. I would see that probably in 4 or 5 years, that particular work stream as about 60%. And then a lot of the Driver Tret work that we currently deliver will be effectively badged as Dialis, but it'll be Dialis advisory. And the people that work on both advisory work and expert work, there will be a pool of our staff that will overlap and work in both areas. So Dialis advisory, Dialis expert will just be a way that we'll identify the two work streams. Essentially, if project services stays as it is, you'll see over 70% of the business as Dialis, be it expert or advisory. And we hope to get there in the next 12 months.
Thank you. That's a nice segue to the next question. Is there a big difference in fee levels in Dialis and Driver Tret?
I'm assuming that what that question means is rates. Do you want to deal with that?
Yeah, we are able to charge a premium rate in the Dialis and expert world, because we're competing more with the legal world. So they're higher, and you can get a blended rate as well because you use a team on projects. So overall, it'll be a higher revenue from that service line.
Thank you. There's a couple of questions here on utilisation rates. Firstly, where do you think utilisation levels perhaps could go to, perhaps by division? And also another question here, utilisation rates are higher in project services and it delivers a stronger EBIT margin typically. Why is this not necessarily being expanded as part of the focus?
Okay, the model in project services is that people are placed into contracts for a significant period of time. Sometimes 1 or 2 months, sometimes 6 months, sometimes up to 2 years. So the people that are placed on effectively on a long-term contract. There is no downtime. It's 100% utilization until that placement finishes, and then it's 0 for a couple of weeks until they're found a new effectively secondment to go into. So the way that service is delivered, utilisation on it needs to be measured separately. The rates, however, are very significantly lower, and it's a different type of resource that's applied. And whilst we can scale that business up a little in the UK, and we have a very competent management team in that division, it's 30% of the business, and it's not got the potential to be 80% of the business. Our much higher rates are delivered on our expert work, which has a much higher gross margin, and that is scalable. So that's the bit that we're growing.
Thank you. You've talked about possibly £1 million of excess capital. Do you have any visibility on how that might be allocated, how that might be spent?
Well, we'll be talking about that as a board and with some of our stakeholders over the next quarter, and we'll come to a plan which makes that decision the best one to add value to our investors. We need to do that in quite a thoughtful and measured way, and we need to plan what we're doing in clear terms. I think we've set out a number of parameters. I see us doing at least one, possibly more than one of those options, and we'll be doing that within the next 12 months. But we'll have some more clarity in the next 3 months as to exactly the timing of that process and which option will be front and centre of that.
Thank you. You've talked about the cost rationalisation process. What is the level of costs perhaps still to feed through from that?
Yeah, we've got about a third to go of our original target that we announced in November 22, and most of that will come from the change in the move in London, which took place, or the lease actually up this month, but we moved in September. So we had a small overlap period there of 2 rents. That's why we say on the slides that the full effect will come into effect from January.
Thank you. A couple of questions about doubtful receivables. There remains £3 million of doubtful receivables, which hasn't reduced significantly during the year. Are these the same receivables, or have there been payments offset by new doubtful receivables?
No, they're not the same. They do move. We do recover. We've had a particular push this year, ably assisted by our regional manager for the Middle East. He's managed to undo some of the previous locked debt out there and get that in. We try to have a policy internally that all debts over a year are provided. So as we recover, some more go in, but we're taking legal action much more than we have before to recover those. Some of them are tied up with government agencies out there, so safe. They just take a long while to actually release the funds. So we're working on those to get it down. The over a year figure for the Middle East is less than £1 million now, which is millions of pounds better than where we were a few years ago, and we've recovered most of that cash.
I think important to just add to that, if I may, that the policies we have about who we're working for across the world are also much stronger and more stringent than they were. And we're certainly not signing off on work for people to undertake for those that we don't think are going to pay us. And I think a few years ago, when we got into some of these things, when you were short of work, there was a temptation to take that kind of thing. And that's not something we do anymore. So the things that we're getting out of, we're not going to be getting back into.
Thanks, Mark. And I think that's touched on the next question, which has come in around, has the company ceased doing work for customers that don't pay or pay on unreasonably extended terms?
Absolutely.
Yes.
Yeah, we have very tight internal controls on when we do allow credit. It has to go through certain limits and certain people, depending on the quantum. You will always get in the Middle East region, particularly slow payment terms to that region. 120 days is sort of our 30 days. So there will be a delay there, especially if you're working with a government body. But we're very careful on who we do extend that credit to. Some
of our insurer clients as well also pay quarterly and have some challenging timing to their requirements to bill. But that is expert work at the best possible rates, so there's no reason not to do it, and they always do pay. But people who might not pay us or are just unreasonable, we just don't work for, because a sale's not a sale until it's in the bank.
The same with the solicitors, if they're on a quarterly billing cycle and they're billing our fees through as a disbursement, we're now making sure that we're onto their billing cycle that they're in, but then we have to wait until they get paid.
Thank you. Do you have targets for dividend cover? And is the dividend something you would expect to retain even in more difficult circumstances?
I think we absolutely have maintained our dividends through some challenging times that we've had as a business, but we have a very strong balance sheet, and we are very careful with our cash. So we're in a position to do that. Do you want to add anything to that?
Yeah, it's something that's on the board agenda at the moment, and we'll be certainly talking about it before the end of H1 as to whether we actually decide and have a policy. But other than the half year of the first year of COVID, I think it's been maintained for a long period of time now. And in fact, it's quite a high, the quantum at 0.8 million each year is quite a high figure.
Thank you. Another question here is about a share-based payments charge. It's a continuing real cost due to dilution, even if it isn't, well, even if it is non-cash. Do you think it's fair to always exclude these since they're not necessarily exceptional?
I think it's just custom and practice and what is done, because it's not part of the operational business really. Yeah, something we do.
Thank you. There are a few questions about people, about hiring, which I'll try and sort of group together. You've talked quite a lot about new people perhaps coming on board as part of the new strategy, but is there a move to retain key existing people as well? And if so, can you give an indication of how that might be?
Well, let's start with the retention of people, because that's an important thing. We are very clear about who key people are in the business. We want to retain all of our people, but we're very keen on clear on who the key people are. We've done that through a range of measures in the past. We've had LTIP schemes. I'm sure we'll end up revisiting that at some point in the future. We also have some other incentive plans that people are locked into cash bonus wise if they deliver certain things. So all of those things are important, but equally there are a number of other things that are non-monetary that also are quite important. I think people need to understand where they can go with their career in a business like ours. They need to see that people are developed. They need to see that they can achieve their aspirations if they want to. They need to understand that they're valued, and that's not just sort of standing next to them handing out money. That's also in some encouragement, some responses that we might give them. During the year, 1 or 2 people in a company of this size will go off sick for a period of time, and we go out of our way to make sure we put an arm around those people and look after them. And we generally try and make sure that we have a positive people culture in the business, across the business. And I think if you spoke to any of our staff, most of them would tell you that that's something that we actually are reasonably good at. There are a number of people who have been in the business more than 20 years. It's rare to go more than a couple of months without us having to send congratulations to someone who's reached a career milestone in the business. There's some people who've only worked for us for their whole careers. So we're doing something right. It's not just monetary. There's a whole strategy that sits around running a people business, and they're individuals. They're not they can't be dealt with necessarily en masse, particularly when they're experts in a number of topics. They might have a number of particular things that they're looking for from their employment, and we need to understand what those things are. I give you one example. One thing that was particularly critical for us recently was to get out of dilapidations clauses in an office that we were occupying recently, and we had to get out of it. And there would have been a very significant penalty to not being out of that office, would be those dilapidations complete at that particular point in time. One of our chaps in London, who's been with us for probably 15 years, I think, has sat on that project and delivered it on time to the day. And got us out of that with no liabilities or problems whatsoever. And we sent him a modest gift in the post with a note saying thank you. And he sent me a note, rang up the next day and said how delighted he was that the people at the top recognise what he does. These things don't cost a lot, but it's all about understanding how you run a people business.
Very clear, thank you. And on headcount and people, you recently increased headcount in Paris and New York offices. Is there anything you can already say about whether this has impacted utilisation levels in the short term, or whether you've been able to win new projects on the back of that?
Yeah, the addition in Paris was centred around a delay analyst, an expert in delay analysis. And that's one thing that we always want to hire, and it's a challenging thing to hire. So when the opportunity came to do that with that particular expert and his assistant, we grasped that opportunity with both hands. That particular expert has worked already on several projects in the Middle East and done very well in those disputes and under cross-examination. And I believe he's also currently working on a project for a Korean client as well, from what I understood. So that was a great hire. And we've also been trying to hire in the US market. The labour market is challenging across the world, perhaps a little more so in the US at this point in time. We're constantly searching for great people. And if the opportunity comes up to hire them, then we will.
And you touched on it then, but the next question says very simply, what is the hiring market like currently? Of course, you've discussed wanting to bring on some great new talent, presumably across a range of markets and perhaps geographies. It's a broad question, I suppose, but you know, how do you see the hiring market as it stands today?
It's always been a difficult market because you want the best highly specialised people. The last 18 to 24 months saw a period of time where it was exceptionally difficult, where there were some PE-backed competitors who were in the marketplace offering ridiculously high amounts of money to people in terms of salary and joining fees and the like. So there was a point where it was extraordinarily difficult, and that was part of what caused us some significant problems in the Middle East. However, 18 months on, the mathematics of those particular equations that we couldn't see how they worked have proven that they don't work. And we've seen a number of competitors releasing people back into the marketplace because they can't make it work. So actually, whilst that's been highly disruptive and problematic to the more stable, secure, long-term employers that we are in the marketplace, it's now becoming easier. It's never going to be really easy. It's never going to be a simple thing, but it's something that's a lot better than it was 18 months ago.
Thank you. And possibly the last one on people, on hiring, on retention. A viewer asks, do you have a credible bonus scheme for your staff?
We really work hard on that, and it's very, very difficult to do. We are working with, or we're going to be working in the first quarter of next year with a consultant who's going to help us review that from top to bottom. Most of those awards are done on a discretionary basis because there are a wide number of KPIs that come into play. You can have someone that's delivered a great deal of work above their target, which ordinarily would and often is a bonusable item. But it may be, of course, that work was won by someone else who may have kept 4 or 5 people busy but be a bit down on their target. Equally, there are some people who have a significant impact on the business outside the fee earning that deliver something credible that helps us. We sit down and agonize over how to deal with our bonus pot. It's always a challenge, always a problem every year because in a people business, you want to reward as many people as possible, but equally, we are a profitable business and we need to be more profitable than we are. So it's a real challenge. We don't have a robust numerical system in place yet. There's always a need to have some flexibility in these things, but it's something that we're going to work on in the new year to try and get a more transparent scheme across the board in place.
Thank you. How will the model for local ownership work? You talked about that obviously in in the context of your transformation strategy. How will the model for local ownership work in the Middle East and APAC?
Well,
what form might it take? I think perhaps might be the inference.
Yeah, it depends where it is, and on there are some businesses that we have at the moment, and there are some businesses that we've been involved in the past where we have had some form of partnership. Some haven't worked, some have worked really well. We had a partnership with Colliers that was very helpful to us in Canada for a number of years and helped them in the Middle East for a number of years. So that kind of model we're experienced at. The way in which a model will work in each particular region will depend upon a number of things, including the appetite for people to become involved in it, the nature of the business, the nature of the marketplace, etc. So there's not going to be a one size fits all. And we'll be sitting down with people around the world when we look at growing outside of Europe in the future to see what the best model is for that particular instance. But we're not able to nail our colours to the mast and try and do a one size fits all model, because that simply wouldn't work for us. What I would say, though, I think, is that having partnerships across the world where people have some skin in the game effectively gives them the opportunity to earn bonuses and rewards, and also helps us share that risk. So we see it as very much the right way to go.
Thank you. Do you currently operate in any of the the related areas you discussed, marine, aerospace, IT that you flagged as part of the presentation?
Yeah, in the marine market, I think I said we mainly do offshore wind and vessel conversions. Aerospace, we've done one project on a particular aircraft that we worked on for a while, where we supplied some commercial and delay staff. We've also done a lot of airport type work in the past, which is sort of overlap with civils and infrastructure. We use a number of laboratories for testing from time to time, rather than having our own forensics lab. And we also, in terms of the financial, for example, experts in accountancy, forensic accountancy, we work with other businesses from time to time, but have not yet secured anybody in our business to be able to do that. But on really large construction projects, there is almost always a need for some forensic accountancy skills. Many of our competitors have that, and it's a gap in our service provision that we're keen to fill.
Thank you. Do you expect the Middle East and APAC regions to move into profit in FY 23-24?
Yes.
Nice and clear. We have a reader here, a viewer who is also a reader of equity development research, I think. Who says they suggest that a new strategic plan could add up to 20 percentage points to gross margin by 2027, which would be around 45% gross margins. Could you break down the contribution of the different levers in the strategic plan to an eventual uplift?
Effectively, we need to do these things all work together. And I think the reason that it's a plan is that it has several strands to it, and we need to do all of these things. So rebranding and consolidating our branding helps. Having that real focus on bang for our bucks from our marketing and BD, which is very focused, also helps. And the number of key experts that we're able to hire to help us build that a little further ahead is also critical. So it's very, very difficult to break that down between those actions to say that any one of them will deliver X or Y. And I think most people watching will probably understand why that's difficult. But I think you have to look at where we're going to be over 4 years. And you have to say, look, if these guys do all of these things, you remember that a moment ago we showed you a chart with a straight line going up at an angle and a wiggly line on top of it. What you'll find is that's how it will be. We will get to that level at the end. At some point along the way, we'll hire a couple of great people and we'll win a couple of great jobs and we'll have a fantastic year. And then, you might find we lose 1 or 2 people at some point a year later, or we have a bit of a drought or a bad quarter or a bad Easter, and there will be what looks like a downturn. And that sort of up and down issue has been a problem in this business for many years. And what I think I said earlier is that we're looking to turn the sharp peaks and troughs into sort of humps and bumps in the road to try and even it out as much as we can along the way, but it will always be a little bit bumpy. It'll never be a flat line type of business. We're not, you know, retailers or manufacturers. We sell the skills and talents of our people wherever they're needed across the world. And sometimes projects stop very quickly. And equally, sometimes you get a phone call and someone says, I need 10 people in Abu Dhabi on Monday. Can you do it? We have to say yes and then work out how. But we always manage to do it.
Great. Well, I think that is it for questions. Thanks to everyone who submitted questions. I'm sure viewers obviously will have seen that the share price has reacted very positively this morning. We will be sending around feedback emails, so please do look out for that. So that just leaves me to thank viewers for their time and for their questions, and to thank Mark and Charlotte for this investor presentation.
Yes.
And we look forward to hearing from you again in around 6 months' time.
Yeah, well, we'll be delighted to do that. We'd also like to thank everybody who's taken the time to dial in today and for your very thoughtful and incisive questions.